Hey guys, it's Crossroads here. I wanted to talk to you today about Palantir and why in the world I would be buying more of this company that I already sold and took profits on at all-time highs and ridiculous valuations. I don't care. I'm buying more anyway. Let's take a look. So Palantir had their quarter two earnings and they were ridiculous. We're going to look at that in just a second, but let's look at the valuation first because you can see why some people might say, okay, this is really weird. So price to earnings is just a low 598. Forward price to earnings, of course, is 277. That's actually showing the ridiculous growth that's happening there. Price to free cash flow, obscene. Price to sales, which matters less, but you can still use it to measure this sector versus its peers. Also obscene. Price to book doesn't really matter. So valuation metrics alone make this look like, oh boy, this is the most stupid thing that a person could do, especially if we look at the chart here. We see Palantir, they hit all-time highs yet again today. That's kind of the trend, if you can see. We're up a little bit from where I was buying it heavily under $10. This used to be it in 2022. My largest position is over 90% in Palantir. Price average was in the 12s. It's still in the 12s as well. I made a small buy for the first time since we were in the 20s. Why would I reverse course and instead of selling, be buying? Well, one is, and I'll put this link in the comments, my huge mistake with Palantir and covered calls, which means I still have a position in Palantir, but ended up because the covered calls were so underwater and I failed to roll them out one time that a large chunk of my Palantir position went away. That's a mistake, a big mistake on my part. And I realized, like, hey, when I did my portfolio review, Palantir rather was not the sizing in my portfolio that I'd like to have it. I don't want it at 40% or 60% or 80% unless like we get a really good dip in Palantir. We'd have to see like $50 or $60 price for that. And I don't think that we're going to see that. So I am buying not because of the valuation. That is a concern. And I do think that, there's other stocks that might perform better going forward over the next 5 to 10 years, but I have 5 to 10 year horizons. This is a company with a very deep moat. How can you tell? Well, one is this is an absolute unicorn. We're going to look at some slides too in the earnings deck, but look at this revenue growth year over year. You look at it versus the industry, and there's some that are like questionable whether they should actually be in here or not. But mostly these are companies you've never heard of. Hey, look, there's Robinhood, not bad. Affirm, but it's much smaller. Frankly, Robinhood is smaller too. Adyen's doing well. Cloudflare is doing really well too. Man, I'd really love for that company to fall. It's just not cooperating because I'd like to have a piece. You can see the profits growth is insane. Of course, they were recently profitable 3 years ago, so don't read too much into that necessarily. But profits growth year over year is up immensely. 3-year CAGR is just phenomenal. Profit improvement as well. You can look at, this is one that we'll look at also in the earnings deck, gross margin over 80%. It's rare when a company grows this amount on the top line and also grows and improves their gross margin. That's actually kind of a bit of a unicorn right there. So let's take a look at the Palantir slide deck here. This is in quarter two, and we see a couple of slides. So first one is, this is called the Rule of 40. Rule of 40 is, in essence, taking revenue growth year over year, which is right over here, and adjusted operating margin right here. And so basically for SaaS, software as a service plays like Palantir, the Rule of 40 was implemented just to kind of guide and help guide investors and investments as something to measure whether or not the SaaS is growing appropriately. And so the goal is to be at least over the Rule of 40. Now, brand new companies in the space don't do that. It takes a little while. It took Palantir a while as well. But you'll see a lot of very good companies that are here just under. Pagaya is doing okay, though I don't know if that's pure. DocuSign is a little bit under. You'd like to see that improve. Adobe is actually 55%. They are far from dead. Intuit is expensive, but I mean, they're doing quite well. FICO. So there's some interesting names here. But what we see is Palantir, 94%. Why? Again, because of this obscene revenue growth and also high margin as well. A lot of times what happens with these companies, by the way, is they'll cut margin. So they'll cut the price on something so that they'll really pump their revenue growth, but they'll lose margin. And that's not nearly as attractive as a company that can actually do both, which is very rare. This is also one of those interesting slides that we're going to talk more of too when I talk some NVIDIA. This is Rule of 40 of the top 25 market cap companies globally. Now, what's insane is Palantir being compared against this. You would not have thought that, 2 years ago, even myself as a very big bull. So again, this is the rule of 40. And you can see that there's some other amazing companies on here. Meta, it's a little under there, but it's a great company. Google is not bad, 52%, very strong. AVGO, Broadcom, very, very good. Microsoft, Visa at 83%, mostly because of the shift on this side on operating margin more so than revenue growth. TSM, 88%. They're killing it. Eli Lilly. And there you have Palantir at 94%. Now, there is one company up here, NVIDIA. Shareholder in that too. Happy shareholder. Amazing revenue growth, amazing operating margins, and they have seen improvement in both as well. And so these two are absolute unicorns. Maybe some of these others are as well, but they are doing really well. Look at some of these numbers. This is not the prettiest slide, but it's actually beautiful as far as its results. U.S. revenue grew 68% year over year. 68%. What's not growing? The only black mark of Palantir is international growth is not and has not been there. We're going to talk about that in a second too. U.S. commercial growth, so outside of government, grew 93% year over year. That's insane. That is absolutely insane. A lot of companies would be happy with this on a yearly basis. U.S. government revenue grew 53%. Government revenue. These are contracts that don't just land, immediately. You can't just sell yourself to them very quickly as a company. It takes a lot of time for these deals to work, and that's accelerating rapidly for Palantir. Again, revenue growth, 48% year over year, just under 50%, crushing expectations, 49% excluding the SPACs in essence. So I think they'll actually hit 50% revenue growth at some point over the next few quarters, which is crazy. You can see the closed deals, the remaining deal value is crazy. Highest ever U.S. commercial quarter, highest ever total contract value. This is what remains as well. Remaining deal value, they're very close and similar. This is not just a one-time bump in a quarter. And that's the really cool thing with Palantir is the type of revenue that they put up. Let's look at the revenue here. It's pretty predictable. They literally have never had a quarter that declined quarter over quarter. There are times when you'll see a slow quarter. This was before that massive acceleration, thankfully by ChatGPT, another slow quarter over quarter. But I don't know that they'll ever have a quarter where they see it go down. Possibly. That could happen. Weird things can happen over quarter. Net income is accelerating. Free cash flow is accelerating. I mean, billings too. This is what's out there, like what they'll be taking in. So it's not just people paying forward. Net dollar retention is up significantly, which is why revenue per top 20 client is also up. And customer count just continues to climb time after time after time. It's very periodic as well. At the same time as, yes, they have increased their operating expenses a little bit. Alex Karp talked about this too. Now, this isn't a concern when you have 50% growth. Basically, you should be happy as a shareholder. And if operating expenses have to go up like 30%, it's like, hey, that's fine. Alex Karp basically, when he was asked or he was talking about future hiring, he said, no, we don't plan to bring on a whole lot of people. We're going to do less with more. It's not because they're not growing. It's not because the demand's not there, but because their own product actually helps them be able to accelerate what they do. One of those biggest choke points for Palantir in the past was the sales cycle and their sales strategy as well. And AIP and also the boot camps ended up solving that. And here, there's still always something that is growing slower than you'd like, that international. We'll talk about that again in just a moment. But also for deployed engineers. These are companies that want to have Palantir engineers come out and basically help them build Palantir into their systems. And that takes time. And there's only so many of these guys that can work for Palantir. They are hiring more. They're bringing on more. But they've actually launched a product through AIP that actually lets them basically have AIP, a forward deployed engineer, right there built into their system, because this is a company that knows how to execute and innovate at a very high degree. The TAM on this company is absolutely immense. Yes, not everything is absolutely perfect. There's a lot of stock-based compensation here, a lot. It's an obscene amount. But if you look at stock-based compensation compared to actual revenue, that continues to go down simply because they are accelerating very rapidly for revenue. And I think that will continue as well, even as operating leverage, the revenue versus actual operating expenses. You see a blip here, and then you'll see that occasionally, but it's not going up tremendously compared to revenue. This is what you want to see in a very strong company. We even see, of course, gross margin just continue to remain strong. It actually has been increasing over the last year, despite the acceleration. And of course, net margins have been doing quite well as well. So this is a company that is ridiculously strong, to the point that a lot of bears have capitulated. They've said, you know what? We actually believe in Palantir now. We were wrong. We'll admit it readily. And I want to actually show you just a little tiny clip from an analyst. There's several analysts that have been bearish on Palantir, not so much just for the valuation. I understand if somebody is. I understand if you as a viewer are like, you know, it's a great company, but it's too expensive. I get that. That's fair. That's a fair take. But there's some that looked at Palantir and said, well, it's smoke and mirrors. It's mostly net interest income. And we'll see how they actually do in the future. And maybe there's a lot of competition out there. No, they're wrong. There's only one Palantir. They really don't have a competitor, not a one-for-one basis. There are companies that can take a little piece and do this and that, but there's nobody that has the same kind of technology. Alex Karp, by the way, mentioned, and one of the things that got me very, very excited is he said that he expects the U.S. commercial growth, so this isn't the entire business, but just U.S. commercial, over the next 5 years can 10x. Now, if you look at the valuation of Palantir, assuming that, and assuming the stock price even stays flat, it's still not cheap, but it's not crazy, especially given that growth rate. So that's one of the reasons why I'm buying more. But let's look at this analyst here. So this is Brent Thiel. He was bearish on Palantir. Again, not just because of valuation for a long time. When bears capitulate, and there's a lot of them, it's not just him, it's meaningful.
And again, this speaks to the testament of how good the products are. We spoke to many customers, and the customers are very happy. They're increasing their spend. They believe in the product. So this isn't necessarily any hocus pocus in terms of the product not working. This is a solution that works and is being driven, and sales and marketing is being driven by success of those customers rather than the steak dinners and the constant sales interaction, which again is another model that many are using in the industry and are following them.
Yeah, I bring this up not because you mentioned steak dinners and golfing, but I was trying to think of analogs for a stock that had this huge run, you know, in its first few years as a public company. Everyone said it was too expensive all along the way, and that would be Salesforce. Now, it had nothing like this revenue multiple, but certainly on an earnings basis relative to its peers at the time, there was a constant kind of big pool of skeptics out there that said, you know, they can't really grow into this valuation. Is there any kind of rationale to that comparison?
There's been no real comparison. I mean, we've seen through the years, right, during you know, the 90s and 2000s, Siebel and what happened there. We saw Snowflake go to 50+ times revenue, and then the multiple came back to single digits, and then recouped the multiple, and then now it's low double digits. We see two stocks right now that are, you know, great companies like CrowdStrike and Cloudflare. You know, they're between 18 and 25 times revenue, but then the gap to get from Cloudflare at 20.
So yes, it's expensive. I would argue it's expensive for a reason. Now, is all of it justified? I don't know. It's hard for me to say. So what I'm doing with Palantir is just doing a very slow DCA, not buying huge amounts. Now, if we get a crash in price like a lot of bears expect, I would be very excited to have a much, much larger position. I don't think so. Now, could we see prices under $100 again, which is quite a bit lower than we're at? Yes, I think that that's possible. There's some noted bears that think that we'll see $50 at some point. I am very skeptical, barring just some sort of horrible crash. They have such a deep moat. They're so differentiated. That's why company after company is mentioning Palantir. If you follow the Quarter app, by the way, it's a really good free application. They're not a sponsor or anything. I just like them. You can put up keywords, keyword indicators that let you know, like when it's a company or a term is mentioned in the slide deck or an earnings call or another kind of press release as well. And Palantir is being mentioned time after time after time by companies that are seeing massive ROI. Now, this isn't from earnings. This is actually from their investor day back in March from AIG. AIG does insurance underwriting. They do a few other things too. They're a very old company. They don't grow very rapidly at all. And this right here is just shocking. It's not a one-off type of situation. This is typical for those that are using Palantir, seeing massive ROI from adopting the product. And then they're excited to use even more, which is why that net dollar retention and why that revenue accelerates so much. AIG expects their adoption of AI-powered underwriting solution, leveraging AIP, which is Palantir's product, to double its 5-year revenue CAGR from 10 to 20%. If you're curious, Look up the last time that their revenue was growing 20% year over year. There's a blip there, but outside of that, over 5 years, it's not a blip. It's not a fluke. It's Palantir. So it's expensive, crazy valuation, but it's a crazy strong company. So I'm going to be buying just a little bit here and there. Not financial advice. I'm not saying you should do it, but that's just the way that I see it. And that's why I've reversed course from selling Palantir and selling too much, frankly, to buying it and adding to my position again. Anyway, thank you for watching, commenting, and subscribing. As always, happy investing.